how is that calculated? So for the purpose of subsection 1, so it now refers back, the rebate shall be what? Shall be an amount equal to the sum of any taxes on income. Now, the word income is important because the word income is defined. Now, the word 10% shares hands. Now, if there was a foreign dividend withholding tax on it, it doesn't fall within 6 quad. You can't bring it in because it was not a tax on the income. It was a tax on on gross income, but not a tax on income, because income is gross income minus exempt income. All right. The second requirement is it must be proved to be payable. Now, this is important because it's a double-edged sword. It must be proved to be payable. So irrespective of whether it's paid or not, it doesn't matter whether it's paid. It must be proved to be payable. So you may, for example, impute a 9D income, but you've not yet paid the tax. You may have paid provisional taxes in a foreign country. It must be proved to be payable. Then you can still get your credit, your rebate. All right. Also, if you've paid an amount more that is proved to be payable, then it also doesn't qualify. So often what happens is that you have a interest, and they will have interest withholding taxes. And in terms of the DTO in South Africa, the interest withholding tax may reduce from maybe 15% to 5%, but they withhold 15%. Now, all that is proved to be payable is 5%. Even though you've paid 15%, what is proved to be payable is 5%. So you only get it on the amount that is proved to be payable. That's critically important definition in this whole thing. Without any right of recovery, obviously, you can't get a rebate if somebody else is going to pay for it. All right. By such resident in respect of any income contemplated in 1A. So that is any income which is from a source outside the Republic, any taxable capital gain, or that is a taxable capital gain from a source outside Africa, or whatever you've imputed as a controlled foreign company, which is so included in the resident's taxable income. All right, so mouthful, but once you start getting into the logic of it, you've got to say it's separate sections. They should actually have had a different section. Section 6 quad rebate, and maybe a 6 or something deduction or something. But the 6 quad rebate 1 and 1A is quite important. You don't have to pay it. It only applies to foreign sourced income. It doesn't apply to South African sourced income. All right. It only applies if it's proved to be payable. If they've paid too much, it's limited to the amount that is proved to be payable. It only applies to whatever is income. So you don't get it on foreign dividends, foreign exempt income. You only get it on income that is a gross income minus dividend income. All right. And then there's a limitation. So the rebate or rebates of any tax proved to be payable shall not in aggregate a loss of 3 million rand. Another country may have a profit of 5 million rand. Then you pull it and you'll say that profit is all 12 million rand. And then you look at all the taxes that you pay there. You pull all the gets carried forward. That 40,000 rand gets carried forward to future years, and you can then use it as a rebate as if it is in the foreign year. All right. So you don't lose the 40,000 rand, but you can carry forward. You can only carry it forward for 7 years. So what you'd like to do is obviously just use the older ones first, so you can get rid of it, so that after 7 years you don't actually lose it. Also, often what happens, you would only do the tax calculations of a foreign branch in a latter period. You already submitted your South African tax return. The 3-year prescription period doesn't apply. It is increased to 6 years if you want to claim the rebate or the deduction. So what often happens is that you may be late with your Namibian taxes of a Namibian branch, and then 4 years, 5 years down the track, you can go to SARS and say to them, please reopen my tax returns for the specific years. I want to claim the rebate for those periods. All right. So there's a 7-year carry forward. But there is a problem because, and we'll show an example of that. If you have a loss in the current year, that foreign income still sets off the loss, but you can only set off the carry forward against future taxable income, not against the current year loss. But there's an example of that. All right. So that is the rebate. All right. The next one, sorry, the title is incorrect. I'll fix that title. We're now talking about the deduction. All right. So when you get a deduction, now that's covered by 1C. So when we talk about the rebate, section 6.1, when you talk about a deduction, it's section 6.1C. So let's go through the detail. For the purpose of determining the taxable income derived by any resident, and this is now quite critical, from carrying on any trade. So if you only get the deduction if you carry on a trade. You do not get the deduction if you do not carry on trade. So if you're just a natural person, you had a loan in Australia, there's a withholding tax in Australia, the source is in Australia, and the DTA says they only need to withhold 5% of interest withholding tax, but they withhold 15%. The 5% is proved to be payable. You can get that as a rebate. The other 10%, even though you've paid it, even though they've withheld it, you can't get a deduction of it because you're not carrying on a trade. It's simply passive. You're not a money lender. All right. At the election of the resident, be allowed as a deduction from the income of such resident. So you can elect on it, but you can't elect between your rebate and your deduction. Okay. Be allowed as a deduction from the income of such resident so derived, the sum of any taxes on income, and this is excluding the amounts on which you've claimed the rebate, envisaged in 1A, section 1.1A. Now there's extension, paid or proved to be payable by that resident to any sphere of government of any country other than the Republic, without the right of recovery. Now, can you see this 1C doesn't talk about source? So you can actually claim it whether the source is foreign or the source is South Africa. You can only claim it when it's carrying off a trade, but once it qualifies for a rebate, you can't qualify here. So in my previous example, if I was a bank, I'm a money lender, I am Nedbank or Capita, Standard Bank, or Absa, whatever, and I'm a money lender. So I've lent money to somebody in Australia. They withheld interest withholding taxes of 15%. They should only have withheld 5%. All right. Then I can get a rebate up to 5%. And because I'm carrying on a trade, and even though the source is foreign, I can get a deduction of the other 10%. All right. So again, when this is in some way or the other refunded, then there will be a recoupment. All right. So very importantly, again, it is limited. The deduction is limited to the foreign source taxable income, or not necessarily foreign source income, because it can also be local source income, but it's limited to the taxable income on which this foreign taxes is payable. All right, so there's also a limitation on this. Then there are rules applicable to the rebate and the deduction. And it effectively says you can choose between DTA relief and 6 quad. But you can't choose between a rebate and a deduction. And people often do that. Say, oh, I'm not going to worry about claiming the rebate. I'll just claim the deduction. It often happens in that way. For example, you are entitled to income. Let's say management fee. People physically went in, They got onto the plane, they flew into Zambia. They were there for 6 months and they did work in Zambia for 6 months. It's below, so they pay tax on a withholding tax of maybe 10% in Zambia. The source of income is in Zambia. You're entitled to a rebate. And what often people will say, okay, you pay me R1 million, there's 100,000 Rand withholding tax, or just bring in 900,000 Rand in as income in South Africa. It's not. You should bring in the full R1 million into income in South Africa, and then you consider whether you get a rebate or not. All right, so the accounting entries from a South African perspective would be debit client, R1 million, credit turnover R1 million, and then when they pay you, they're only going to pay you 900,000 Rand. So your debit cash, 900,000 Rand, credit client debtor, 900,000 Rand. So you're left with 100,000 Rand there on the debtor. So that 100,000 Rand, you say he doesn't owe you anymore. So you go credit the debtor 100,000 Rand and debit foreign taxes, which is a balance sheet item, with 100,000 Rand. So you're lying with a debit on the balance sheet of 100,000 Rand because it's foreign taxes that you pay. Then you look at that debtor and you say, okay, this debtor, can I get a rebate or can I get a deduction? If the income is South African sourced income, you can get a deduction of it. And then you can decide what you're going to do is credit that amount and debit expenses, but you can get a tax deduction for that. So you may actually decide to do it above the line. But even if you do it below the line, then it will be a permanent adjustment difference. If you get a rebate for it, then you say credit that amount and debit SARS. To the extent that you're not going to get a rebate for it, you will invariably impair it and show it below the line as a foreign tax charge, and it will affect your rate recon. All right. So, so you've got a choice between DTA relief and 6-quart relief, but you don't have a choice between the one or the other. And this is now quite important because many people get this wrong. What you need to do is you take all your foreign taxes paid in foreign currency. You add it all together. You have the amount of income that you have, the foreign taxes in the foreign currency. You get at the end of the year and you convert it at the average exchange rate and not at the spot rate. Invariably, I see that people converting it at the rate that they actually receive it or that they receive the money, but you should keep track of it. So in your tax pack, you must have a Section 6-quart schedule. And in the Section 6-quart schedule, you have to say what is the country origin, what is the nature of it? Is it withholding tax on technical fees, withholding tax on interest, withholding tax on a management fee, whatever the number would be. And then next to that, you'll say, what is the source of that income? You have to say, do I get a rebate or get a deduction? You have to have it in the foreign currency, and then you convert it at the year-end spot rate, which is published by SARS. So you go into the SARS website, you put in the search function average exchange rate. It takes you, there are 3 tables there, takes you to table 1, and you say, what's my average exchange rate? If it's not published there, then they give you guidance on how to actually calculate it. All right. And this is what I said, the 6.5 overrides the 3-year prescription period. So you can actually go back 6 years if you want to claim foreign tax rebate or a foreign tax. All right. So interpretation note 16, many of the things that are in explanatory notes I've already talked about, but let's re-emphasize it. And this is extracts from the interpretation note. So it talks about the rebate method of relief of foreign taxes. Again, the rebate. The following rebate methods are currently employed in South Africa. 6.1, which is the principal method used to provide relief for foreign taxes, proved to be payable on income derived from a foreign source, which is included in your resident taxable income. Importantly, foreign taxes proved to be payable income derived from foreign source do not qualify for deduction under 6.1. 6.1 provides for the deduction of foreign tax against your normal tax payable. In the deduction, under Section 6.1c, a resident may claim certain foreign taxes that are not contemplated in Section 6.1. So that's the secondary one, as a deduction in determining taxable income derived from carrying on a trade that is essentially foreign taxes paid or proved to be payable on South African sourced amounts and foreign taxes paid but not proved to be payable on income derived from foreign source. So you can see you can get it from South African source income as well as on foreign source income. All right. The explanatory memorandum elaborates a bit on what is source of income. So you need to you need to be familiar with the source of income. But remember, there are three categories on how something can be from a particular source. The one is just the common law. So, for example, if you were to physically get on the plane, you fly to Zambia, you physically do the project in Zambia, and you come back again, you charge fees there, then the income undoubtedly is sourced in Zambia. So, common law, it is sourced in Zambia. All right. But if you were to do but if you were to sit in South Africa behind your computer and you would provide them with a technical services, IT services, I will provide a tax opinion. Then my source of income is where I'm situated, and then the source of income is in South Africa. So if I were to charge somebody for tax advice, I'm sitting in South Africa behind my computer and giving them tax advice. My income is from a South African source. If I'm charging somebody in Zambia, then I can get a deduction and not a rebate if they withhold any foreign withholding taxes on it. All right. But if I get on the plane, I fly to Zambia, I sit there and work, then my income is in a Zambian source, and then I can get a rebate and not a deduction. That's the common law. If I were to do exactly the same thing, but I do it with Botswana, then when I'm sitting in South Africa and I'm doing a tax opinion for Botswana, obviously, the normal source of income is in South Africa, but the DTI says any technical services is deemed to have a source in Botswana. So then the DTI overrides it, and then even though the actual source is South Africa, I can still get a rebate because the DTI says that for Eswatini and for Botswana, that the source is deemed to be in Botswana or Eswatini. It's deemed to be there where the payer is situated. Same with Namibia on interest, where for interest purposes, even if I were to lend somebody in Namibia money and they were to apply it in South Africa, then Section 9 comes in and says, even though you lent it to a Namibian person, Section 9 says it's deemed from a South African source, and then back again to the DTI, and the DTI said, no, it's deemed to be a Namibian source. So you can see that three things. Section 9 is deemed source, common law is actual source, and the DTI overrides both. All right, so you've got to be careful and look at those things. Proof to be payable, I've discussed that. It must, to get a deduction, you only get it up to the proof to be payable. So if your foreign company just doesn't worry about the DTI, and I've had clients that they've had big fights with foreign entities, and the foreign entity, then we say, but hang on, the DTI says you've only got to deduct 5%. They say, no, we're taking a prudent view and we're deducting 15%. You can almost get a credit in South Africa. You can't get a credit for the extra 10%. You can get a deduction. So the best you can get out of it is 27% of that excess amount that they withhold. So you've got to actually, especially if you have multi-jurisdictional agreements, make sure that that you've got certainty about the withholding taxes that's going to be deducted. Is it in the DTI? Is it not within the DTI? And because if they are deducting more than what the DTI allows, you only get a deduction for the excess amount. And this is the formula that I'll set out, and we'll do a number of examples on this. Now, this is quite interesting. Please read paragraph 9 of the interpretation note, because it tells you what documentary evidence. Essentially, they're saying, I mean, we can't have a one-size-fits-all, because you do not know what documentation they will give you in Qatar or in Australia or in Japan or wherever. So they can't be prescriptive, but they can give some kind of guidance on it. All right. So there's some basic information. At least you should know what the foreign tax year is. You should know the name of the tax in the foreign country, the name of the law under which the tax was imposed. That's quite important. Is it an income tax act? Is it a withholding tax act? Is it a dividend tax act? What is it? So that SARS can actually apply the mind, and whether the tax was levied by the national government, the state or local authority, and the name of such authority. So in Switzerland, you'll have all these canton taxes that they pay. In America, you have all the different state taxes that you pay. So SARS need to be in a position to evaluate whether or not it is a tax paid to a foreign government. All right. Additional information required when the foreign tax has been withheld at source. So if the tax has in fact been withheld, in practice, you really struggle often to get proof of payment from the foreign tax authorities. And in the olden days, we always struggled to get it. But SARS now allows you a certificate of tax withheld issued by the person withholding the tax. Because often what happens, they will make a lump sum payment. So they may have, it may be an entity in Kenya, and they've got numerous people providing services to them, and they will all collect them all, do a batch payment to the tax authorities, and they don't have a specific amount that they can say, well, I've paid so much for you and so much for you and so much for you. Then they have a batch reporting. So in that case, you can have a certificate of the tax withheld by them and saying, this is the amount that I have, or you can have a copy of the actual proof of receipt. So that's when you've actually paid it. If you have not actually paid it, but it's proved to be paid due and payable, it was not withheld at source, and there is a foreign self-assessment. It's like you are required to register for VAT in the foreign country. Now, obviously, VAT won't apply for this, but withholding, some kind of withholding tax that you have there. Then certified copies of any taxes that you have, if it's some kind of self-assessment that you have there. If it's similar to South Africa, again, you have got a branch in Namibia and you have to submit a tax return in Namibia, then you need to have some information there, even a calculation from the auditors, or some kind of affidavit from the auditors that it is due and payable. All right, let's get to some examples in the last half an hour or so. This explains just the way in which a rebate and a deduction works. So there are example one, gives you a few different scenarios. So A, trading income derived from country A. The income consists of a foreign sourced income. 15,000 Rand of foreign taxes was withheld. So under A, because the income is from a foreign source, you can potentially qualify for a rebate, not a deduction. Fees received for managerial services rendered in South Africa to a person resident in country B, the income is South African sourced income. So under B, you do not get a rebate. You can only potentially qualify for a deduction. C, royalty income. And the royalty income consists of a South African sourced income. So, for example, you have a brand, maybe a fast food chain brand. That brand is registered in South Africa and you receive a royalty income from that. Or you have written a book, and when the books are sold in foreign jurisdictions, or you write music and you get royalty income from that, and where you have written the book or where you have made the recording for the music, that's your actual source. The royalty income that you receive, you only can get a deduction and not a rebate. So you've got to be careful with those things where it actually is. This just explains the difference from a commercial perspective, and clearly there, under the deduction method, so in this example, you have 100 Rand on which foreign taxes of 25 Rand was payable. So what's the difference? So the taxable income from a South African source is under the deduction method. You get 100 Rand, you get a deduction of 25 Rand. Okay, so you've got 75 Rand, you pay South African taxes of 21 Rand. Your effective tax rate is the foreign taxes of 25, the South African taxes of 21, the effective rate is 46%. If you get a rebate, you include the 100 Rand still into your taxable income, you pay your 27%, in this example still 28%, then you get a rebate with the maximum up to the foreign sourced income, and you pay additional 3, so you pay 28%. So you can see it's much better to be in a rebate position. All right, from a priority perspective, if you're a natural person, the 6 and 6 quad rebate ranks last. So you first do your primary, your medical scheme, primary and judicial medical scheme, then that's your taxes. And then you, based on that taxes, you do your calculation of foreign taxes. Under any companies or so, you do not have those primary rebates and things. So obviously you just have your normal tax payable, and you have this single rebate that you calculate. All right, let's look at a few examples. So South Africa has concluded a tax treaty with country X, under which the latter may levy a withholding tax of 10% on the gross amount of interest being remitted from country X. However, country X levied tax at the rate of 25% on the interest income remitted to a resident in South Africa who did not carry on a trade. So, the example, the resident has an unconditional legal obligation to pay tax at 10% because the DTA says 10%. You don't have a liability to pay 25%, even though 25% was withheld. The resident may claim a rebate to the extent of 10% as specified in the tax treaty. The remaining tax of 15% is forfeited. It may not be claimed as a deduction because why? You're not carrying on a trade. So remember, you get a rebate even if you do not carry on a trade. You get the deduction even if you do, only if you carry on a trade. If you did carry on a trade, for example, you were a bank, you get a rebate for the 10%, and the other 15% you get a deduction for. Okay. A resident renders services to company B in country D. A does not have a permanent establishment in country D. Company B withholds and remits 10% withholding tax to country D's tax authority. The income is from a foreign source. So firstly, you say, okay, it's from a foreign source, so I should be getting a rebate. So now I look at it, but now I've got to go to the tax treaty. South Africa has a tax treaty with country D. The tax treaty says nothing about technical services, meaning that no matter what, country D does not have the right to tax it, and South Africa has the sole taxing right to tax it. And then in terms of the DTA, because the foreign country doesn't have the right to tax it, you cannot get a rebate for it. But if they did withhold it because you are trading, you can get a deduction for it. So the three categories: what's the actual source? What is the deemed source under 9? And what's the DTA? And then you should go, even though all the other requirements are there, does the DTA give them taxing right or not? So if it didn't give them taxing right, and despite that you paid the foreign taxes, you can't get a credit on it. So it brings in a dimension in your foreign tax planning, because a lot of people say, well, I'll just take the route of least resistance. I've got it. I'll pay my taxes there and get over and done with it. But this is a battle between governments. So South Africa might sit there and say, well, hang on. You can't just say I am prudent and I'll pay my tax there. You've got to go and say, do I really have to pay my tax there? And because I'm not going to pay for your prudency. All right. C, a resident renders services to company D in country E. So C does not have a permanent establishment in country E. Company D withholds and remits 10% withholding tax to authorities in country E. The income is sourced in country E, so it's foreign source income. So South Africa tax treaty with country E contains a technical services article permitting E to deduct it at 10%. All right. So the foreign withholding tax qualifies as amounts proved to be payable since it was withheld in accordance with the treaty, and therefore you can get your rebate for the full amount, obviously subject to the limitation. Now, this is the example that I previously mentioned. This is where you have a DTA. You lent money to a Namibian resident, and the Namibian resident uses the money in South Africa. Now, Section 9 then deems that source to be from a South African source. But the DTA then overrides Section 9 and says interest shall be deemed to arise in a contracting state when the payer is that state itself, a political subdivision, a local authority, or a resident of that state. So even though the money, you lend the money to a Namibian tax resident, that Namibian resident then uses it physically in South Africa, then it is still deemed to be a Namibian source, and you can still get a foreign tax credit and not a deduction, even though the source in terms of 9 is deemed to be a South African source. The DTO overrides it and says it is a foreign source. The same thing applies to Eswatini, and Botswana is also the same example, where they say technical fees shall be deemed to arise in the contracting state when the payer is a resident of that state. So I said in South Africa, I've got a call center in South Africa, and I provide technical IT advice. People will dial in and ask some questions. So if you charge somebody in Eswatini, I mean, your call center is physically in South Africa, you charge them and they withhold 10%, you can still get a rebate, even though the actual source is South Africa. It's because the DTA with Eswatini says, no, the source is deemed to be there in South Africa. And Botswana's got the same terms. Technical fees shall be deemed to arise in a contracting state when the payer is a resident of that state. All right. And yeah, they just elaborate on it. So, but if they then withhold a withholding tax of 15%, and the DTA only says you can get 10%, and the extra 5% will qualify for a deduction. All right. So this is just an example of the carry forward of the income. So in this case, this is an interesting example. Company A resident, received foreign sourced income from country S of 100,000 Rand, and they are allowed 40,000 Rand in that country, and then they pay tax of 10% on that profit of 60,000 Rand. So they pay 6,000 Rand of foreign taxes. The income is also taxable in South Africa at the rate of 28%. Let's just assume it's before the 27%, with deductions of only 30,000 Rand available in the Act. Now, this is an important point. Even if you work out your foreign taxes based on the foreign tax legislation, you've got to work out, when you do the South African tax legislation, you've got to work it out as if it's a South African tax legislation that applies. So the company also conducts operations in South Africa and receives income of 250 and incurred expenses of 350. All right, so how do you calculate it? As I said, you've got to put two pools of calculations there. The one is your foreign trade and the one is your South African trade. In your foreign trade, you will say what your gross income of 100,000 Rand, less the deductions, and only 30,000 Rand, based on South African legislation. Even though in the foreign country, 40,000 Rand was allowed, in South Africa, only 30,000 Rand is allowed based on our legislation. All right, so foreign taxable income is 70,000 Rand. In South Africa, you make a loss of 100,000 Rand. So now you've got a loss of 50,000 Rand. Now, your rebate is calculated based on that formula, foreign sourced income of 70,000 Rand divided by total taxable income, which is a minus 30,000 Rand, multiply South African tax. South African tax is 0. So even though you've paid 6,000 Rand, you can't claim it. SARS not going to pay it back for you. The 6,000 Rand gets carried forward for 7 years. All right. But if you look at the logic of it, you still lose out because your assessed loss has reduced from 100,000 Rand to 30,000 Rand. In the next year, when you calculate the limitation, you can only take into account, because tax is an annual event, the foreign trade income in the next year. You can't then go and backtrack and add the 70,000 Rand in. You lose that 70,000 Rand forever. So you often get that, you have foreign sourced income, you have South African losses. Okay, your South African losses provides a buffer, and you don't pay tax on the foreign source income, but you pay foreign source taxes. In the next year, you now move in a taxable position again, but you only receive maybe 10,000 Rand of foreign income. Then your limit, the 6,000 Rand and the tax on this on 10,000 Rand, could only be offset against the new 10,000 Rand. The 70,000 Rand for the prior year, you lose. You can't take that into account at all. And for that reason, you often need, you remember what I said on a rebate, your accounting entries are debit, taxes prepaid, foreign taxes prepaid. It's a balance sheet item. And if you look at that amount, even though you can carry forward the 6,000 Rand, the 6,000 Rand lies in your balance sheet because it is effectively a tax that's being prepaid, 6,000 Rand on the balance sheet. If you think you can't use it, you've got to impair it. All right, so you may need to impair that. And once you impair it, it goes below the line. It's a tax charge as a foreign tax payable. All right. Let's look again at some foreign trading losses. A company A resident, conducts its primary trading operation in South Africa, and it also has a branch in country N. Okay, so the first, let's do it year by year. In year 1, company A receives trading income of 100,000 Rand from a South African source. Its branch in country N incurred a loss of 300,000 Rand. So let's do the tax for year 1. The branch has an assessed loss of 300,000 Rand, but you can't set off your foreign losses against the South African income because of your proviso to Section 20. which says that you can't set it off, and I've copied it in there. So in year one, you're going to pay tax on the 100,000 Rand in South Africa. Okay. The foreign assessed loss of 300,000 Rand is ring-fenced under paragraph B of the proviso and is carried forward. The local trade income of 100,000 Rand is subject to normal tax at 28%. Okay. But the 300,000 Rand gets carried forward. So that is in year one. Taxable income in South Africa, 100,000 Rand, you're going to pay your 28% on it, 27%. The 300,000 Rand gets ring-fenced and it gets carried forward to the next year. In year two, company A received trading income of 100,000 Rand from a South African source. Its branch in country N derived taxable income of 400,000 Rand, on which it pays tax of 5%. So let's do the tax in year two. So again, you've got to do foreign tax, local tax. Okay, so in the foreign tax, your tax that you pay in the foreign country is 5,000 Rand because it's 400,000 Rand minus the 300,000 Rand gives you 100,000 Rand. Their tax rate is 5%. So your potential rebate is 5,000 Rand. Then you do the South African calculation. As I said, in your South African calculation, you've got to split it out. Taxable income from a foreign source, taxable income from a South African source. Taxable income from foreign source is the 400,000 Rand for year two, but you can bring your 300,000 Rand in at that level, so there's only 100,000 Rand. And then your trade income in South Africa is 100,000 Rand. So now you're paying tax of 56,000 Rand in South Africa in year two. So in year two now, what is your rebate? So your rebate is based on that formula. It's your taxable income from foreign sources, which is your 100,000 Rand. Your taxable income from all sources, which is 200,000 Rand. Multiply your normal tax payable on B, which is 56,000 Rand. So your maximum amount that you can claim is 28,000 Rand. You've only paid 5,000 Rand, so you can get that as a rebate. Just remember then, with effect from years of assessment ending on or after 31 March 2023, the amount of the assessed loss to be offset is the higher of 1 million Rand or 400,000 Rand times 80%. See? So that 400,000 Rand times 80% being, but obviously in this case, you've had it's less than that. So remember that 80% rule also applies for foreign losses, not only on South African losses. So be careful for years of assessment ending on or after 31 March 2023. As you're calculating your foreign taxes, that you also know that the foreign losses is also subject to this 80% rule. Okay, interesting example. Example 6, a set off of foreign trading losses. So let's look at the example. Company A, a resident, conducts operations in country S. So now I've got 3 countries. Country S, I've got country T, and I've got South Africa. What happens in country S? In country S, there is income of 20 million Rand, deductible income of 10 million Rand, and foreign tax of 4 million Rand. Okay, they pay 40% tax. Company A, so in country T, it gives rise to income of 10 million Rand, deductible expense of 14 million Rand, so there is a loss of 4 million Rand in that country T. And in South Africa, I've got 15 million Rand of income and tax deductible expenses of 10. So I've got taxable income of 5 million Rand. So let's do the calculation. And again, as I said, you've got to pull it. Like foreign operations, South African operations. The foreign operations, I'm operating in country S. What happens in country S? There's a 10 million Rand taxable income, all right, on which I've paid 4 million Rand of foreign taxes. I've got assessed loss in country T, which now reduces that amount. So my taxable income from foreign operations is 6 million Rand. My South African operations is 5 million Rand. And the tax on my combined is 3080. So what's my rebate? My formula says taxable income from all foreign sources, it's the 6 million Rand, divided by my taxable income from all sources, which is the 11 million Rand. So the 6 divided by 11, multiplied by the 3080 gives me 1680. So even though I've paid 4 million Rand, my rebate is limited to 1680. The balance of 2320 gets carried forward for the next 7 years. All right, so you can see that you only include 6 million Rand, but your rebate is not limited on a country by country. It's limited to the full 6 million. It's the 6 million divided by 11 times the 3080. That's your limitation. It's not 10 divided by 11 multiplied by 3080, it's 6. So both are pooled. Your income is pooled, all your foreign sources, and then your tax rate is pooled as well. It's a very important example. All right. Let's look at another example. It's a relatively simple example. Company Z, a resident, received income for independent professional services in country A. The presence in company Z in country A did not create a PE for you in that country. So in year 1, you received gross income of 100,000 Rand and operating expenses of 80,000 Rand in country A. So you've got country A, 20,000 Rand of taxable income. Country A levied tax on that at 10% on gross receipts. So now it's not in your taxable income, but it's in gross receipts. So they take 100,000 Rand times 10% and withhold that 10,000 Rand there. You had other taxable income of 50,000 Rand in South Africa. So now, what is your South African tax? It's your foreign sourced income of 100,000 Rand minus your 80,000 Rand attributable to that 100,000 Rand plus a South African tax income of 50,000 Rand. All right. Times 28%, so that's 19,600 Rand. You work out a limitation. It's your taxable income from all foreign sources. So even though the tax was paid on the gross amount of 100,000 Rand, it's still limited to the taxable income. So you've still got to attribute expenses to them. So you often find that on a withholding tax on technical services where you charge them 100,000 Rand, they withhold 10%. Now, I've seen it so many times. People then limit the deduction to the 28% on the 100,000 Rand. No, you've got to allocate expenses to the 100,000 Rand. It's limited to the 28% or 27% on that taxable income. So you still got to go back to the formula constantly. Taxable income derived from all foreign sources divided by taxable income from all sources multiplied by the normal tax payable. So 20, which is 100 minus 80, even though the tax was calculated in 100, it's 20 over 70 times 19,600. So the maximum amount is 5,600 Rand that you can deduct. Because they withhold 10,000 Rand, you can only get a 5,600 Rand deduction. The balance of 4,400 Rand gets carried forward to the next year. This example illustrates the treatment of indirect expenses. So you've got to have your columns because, as I said, you've got to calculate your calculation on South African sourced income and foreign sourced income so that you can have a total taxable income. So in this case, you conduct activities in South Africa and in country L, all right? And that's your total. Your turnover is 8,000 Rand. You've got direct expenses of 2,800. So normal tax calculation is 10,000 minus 2,800. But now I've got indirect expenses, things like buildings, rent, audit fees, directors' fees, all of those kind of things. Of indirect expenses was 600 Rand. So your taxable income for all sources is 6,600 Rand. The foreign taxes that you've paid is 108 Rand. Okay, so your South African tax is 6,600 times 1,848. So how do you do your calculation? You've still got to do taxable income derived from foreign sources. And as you can see there, you take your taxable income from foreign sources is the 2,000 minus the direct expenses minus a reasonable allocation of the overheads. Overhead is 600. So in this case, SARS says let's base it on turnover. It's not law. You can apply a different basis. So the law doesn't tell you, the law doesn't force you to do on turnover, but you've got to apply a just and reasonable methodology of allocating indirect expenses to both South African sourced income and foreign sourced income when you calculate it. All right, so that then comes into your calculation there. All right. Let's look at another example. Resident company A conducts its trading operations in South Africa. It also has a branch in country L. So the following results. So in South Africa, you've got 2,000 Rand loss. In country L, you've got a 3,500 Rand profit. So you've got 1,500 Rand in total. The foreign taxes is 700 Rand, but the South African taxes is only 1,500 Rand times 28%. All right. So you are paying the 420. When you look at the formula, you would normally say taxable income derived from all foreign sources, you'll say 3,500 Rand divided by taxable income from all sources be 1,500 Rand, but your ratio may not be more than 100%. So what you'll get is a tax deduction of a maximum of 100%. You can't get 35 over 15 and actually claim more than the 420 that is in South African. Your maximum is the 420 that you pay. All right, so that is Section 6 quad. As you can see, it is very, very complex. You can't just do it as an afterthought. Your foreign taxes require active management. It is not just a system of let's just keep track of what the amount of foreign taxes is that I pay, and then I just simply claim a rebate. You have to actively look at the originating cause of each one, and then you have to pool all the foreign taxes. You've got to pool all the foreign income, do the formula, look at what qualifies as a rebate, look at what qualifies as a deduction, and do the calculation appropriately. It is a high-risk item, and you have to have proper working papers supporting your calculations, because otherwise you may be liable for understatement penalties. Also look at it from an accounting perspective, and particularly the way in which you account for technical fees, for royalty fees, all of those kind of things. So often I would see that people will simply have, I issue an invoice for 100,000 Rand, and you only pay me 900. I then just write off that 100 as an expense in the income statement. It's not an expense in the income statement. You must first go to the balance sheet, and then from the balance sheet you decide you get a rebate, you get a deduction, or whatever goes on from there. And whatever you do not get your bang for your buck, you've got to do the disclosure properly in your financial statements. Thank you so much for your time. We will have another tax chat around about the 20th of February. It may go up or down. We probably may extend it a little bit later or a little bit earlier, depending on the budget date. And then we may include just some new court cases. I've not yet finally decided what the agenda for the next time would be. If you require any certificates for attendance for today's webinar, please email Michaela, and then also email Michaela, and she will distribute the slides, and she will also distribute the link to the recording. Thank you so much. I hope you have a wonderful day, and thank you for your attendance. See you in February.